The man who saw the 2008 financial crisis coming, the man Christian Bale played in The Big Short, just placed a $1.09 billion bet that the entire artificial intelligence boom is about to collapse. And 5 days after he filed it with the SEC, he shut down his hedge fund and walked away from Wall Street entirely. His name is Michael Burry. The fund was Scion Asset Management. The trade is one of the most asymmetric financial wagers in modern history.
My number one concern is there's been a complete, utter, total abdication of personal responsibility.
On November 3, 2025, Scion filed its quarterly 13F with the SEC. Buried inside was a position that stopped Wall Street cold. 50,000 put contracts against Palantir Technologies. 10,000 put contracts against Nvidia. A separate position in deep out of the money puts against the iShares Semiconductor ETF. The financial press immediately reported a $1.1 billion short bet against AI. Technically accurate, but fundamentally misleading. Today, I'll walk you through what Burry actually did, why it cost him a tiny fraction of the headlines, the specific accounting fraud he says is hiding inside the Magnificent Seven balance sheets, and why 7 days after the filing, he deregistered his entire fund and quit. Let me start with the trade. The 50,000 Palantir puts had a strike of $50 and an expiration of January 15, 2027. The 10,000 Nvidia puts had a strike of $110 and an expiration of December 17, 2027. Each contract controls 100 shares, so 60,000 contracts controls 6 million shares of underlying equity. Multiply by the prices Palantir and Nvidia were trading at, and you get a notional value of approximately $1.098 billion. That is the number every headline ran with. Here is what they all missed. Notional value is not cash at risk. Burry did not put up $1 billion. He bought options. Options have a premium, the cash you actually pay. The Palantir puts were acquired at an average premium of approximately $1.84 per share. Multiply by 5 million shares of exposure, and his actual cash outlay on Palantir was $9.2 million. Pricing models suggest the Nvidia premium was between 5 and 8 million. Total real money at risk, somewhere between $14 and $17 million, not $1 billion. Less than 2% of the headline number. This distinction is everything. Burry's maximum loss is capped at the premium he paid. Unlike a traditional short sale, where losses are theoretically infinite, a put option is defined risk. He can lose the $17 million in premiums. That is the floor. But if Palantir or Nvidia collapse, he controls $1 billion in notional exposure on the way down. $17 million in risk against potentially hundreds of millions in payout. This is exactly how he structured the 2008 subprime trade. He did not short bonds outright. He bought credit default swaps, defined cost up front, asymmetric payoff if housing collapsed. Same playbook in 2025, except the target is silicon instead of mortgages. 5 days after the 13F filing on November 10, 2025, Burry officially deregistered Scion Asset Management with the SEC. He shut the fund down, returned all capital to his 4 limited partners, and walked away from running outside money. In his closing communication, he wrote one sentence that should make every investor stop and think. Quote, "My estimation of stock values is not now, nor has it been for some time, in tune with the market." End quote. This is not a tactical short. This is a man who concluded that public equity valuations have completely detached from economic reality. 13 days later, on November 23rd, he launched a paid Substack called Cassandra Unchained, $379 per year. Within weeks, it was the most read independent financial publication in America. Now the actual thesis. The AI short is not about hating technology. It is a specific accounting argument that, if Burry is right, exposes one of the largest profit overstatements in corporate history. He calls it the depreciation manipulation thesis. When Amazon, Microsoft, Alphabet, or Meta buys a $50,000 Nvidia GPU, they do not expense it immediately. They capitalize it on the balance sheet as property, plant, and equipment, then depreciate it over its expected useful life. The longer the useful life they claim, the smaller the annual expense, and the higher the reported earnings. Burry's argument is simple. The actual technological useful life of an AI chip is 2 to 3 years, Hopper to Blackwell to Rubin. Nvidia ships a vastly superior architecture every 24 months that renders the prior generation economically uncompetitive. Yet the hyperscalers, in the same window they were buying these chips by the billion, all extended their accounting useful lives. Meta went from 3 years to 5.5, Alphabet from 3 to 6, Oracle from 5 to 6, Microsoft to 6, Amazon from 4 to 6 in 2024 before pulling back to 5 in 2025. Accounting useful life is now 5 to 6 years. Technological useful life is 2 to 3. The math is brutal. Spend $100 billion on AI servers and depreciate over 3 years, annual expense is $33.3 billion. Over 6 years, it drops to 16.6. The difference, $16.7 billion per year, is what Burry calls phantom profit. It exists only on paper. He calculated the aggregate impact. Total hyperscaler capex from 2026 to 2028, projected at $1.7 trillion. Subtract baseline pre-AI spending. Roughly $400 billion per year is attributable directly to the AI boom. 70% is silicon, so $280 billion in chips per year. Stretch depreciation from 3 years to 5, and you create a $176 billion cumulative understatement of depreciation expense between 2026 and 2028. $176 billion in earnings that, in Burry's view, simply do not exist. He projects that by 2028, Oracle will be overstating earnings by 26.9%, Meta by 20.8%. He posted on X verbatim, quote, "Understating depreciation by extending the useful life of assets artificially boosts earnings, one of the more common frauds of the modern era," end quote. The Capex bubble is staggering. Goldman Sachs estimates aggregate AI infrastructure investment will reach $1.4 trillion between 2025 and 2027. By 2031, cumulative build-out could hit $7.6 trillion. In 2024, global hyperscaler capex equaled approximately $800 million per day. Microsoft is committing $190 billion to capex in 2026 alone. Meta raised its 2026 capex range to between $125 and $145 billion, more than doubling all net profit Meta has generated in 15 years as a public company. Amazon's free cash flow contracted from positive $3.6 billion in Q4 2024 to negative $12.4 billion in Q1 2025. Alphabet announced a debt sale expected to exceed $30 billion to finance up to $185 billion in 2025 AI spending. The sector is borrowing aggressively, slashing buybacks, betting AI revenue will eventually justify the spend. Now Nvidia. Nvidia is the explicit target of the puts because Burry views it as the modern Cisco. In fiscal year 2026, Nvidia reported revenue of $215.9 billion, up 65% year-over-year. Net income of $120.1 billion. GAAP gross margins at 75%. The highest hardware margins in the history of capitalism. Burry's argument is not that Nvidia is a bad company, it is that maintaining 75% gross margins as a hardware manufacturer is structurally impossible. The hyperscalers are now actively building their own custom silicon. Amazon Trainium, Google TPU, Meta MTIA. The purpose of these in-house chip programs is to break Nvidia's pricing monopoly. And Nvidia's accelerated annual release cadence creates what Wall Street calls air pocket risk. As Rubin ships in late 2026, hyperscalers may pause Blackwell orders to wait. Revenue mismatches like that are not priced into a stock trading at a forward PE of 25. Now, the counter-argument. Bill Ackman of Pershing Square is on the exact opposite side. As of his Q4 2025 13F, Pershing holds 9.6 million shares of Amazon, valued at $2.2 billion, 14.28% of the entire portfolio. Ackman believes AI capex creates an insurmountable competitive moat. Defenders of the depreciation accounting argue that while a GPU may train frontier models for 2 to 3 years, it is then repurposed for less intensive inference workloads for the back half of its physical life. Useful life of 5 to 6 years, they argue, reflects the blended workload, not fraud. And the biggest risk to Burry's specific position is timing. His puts expire in late 2027. If the market keeps grinding higher, those options expire worthless and he loses every penny of premium, even if his thesis is ultimately right. He has been famously early before. His track record is mixed. He generated $100 million in personal profit and $700 million for Scion investors on the 2008 subprime trade. In 2021, he shorted Cathie Wood's ARK Innovation ETF. ARKK fell over 63%. Vindicated. He shorted Tesla in 2021 with a $731 million notional position. Mixed timing. In January 2023, he posted a one-word tweet, sell. The S&P then rallied over 30%. He admitted, quote, "I was wrong to say sell," end quote. But here is what almost nobody noticed. In the same quarter, he tweeted sell. His 13F showed Scion expanding into 21 new positions worth $106 million. His tweets are macro warnings. His SEC filings showed disciplined, risk-managed portfolio construction. The Nvidia and Palantir puts are not a Twitter rant. They are a defined risk option structure. And he is not alone. Berkshire Hathaway sits on $390 billion in cash and treasuries, 14 consecutive quarters as a net seller of equities. Stanley Druckenmiller exited his entire Meta position in Q4 2025, citing unsustainable AI Capex. Jeremy Grantham at GMO forecasts negative 2.7% annualized real returns for U.S. large cap over the next 7 years. Jim Chanos has warned AI valuations are approaching 2021 speculative extremes. The smartest, most patient capital allocators are all positioned the same way: defensive, cash-heavy, skeptical. So what would Vindicate Burry's trade? 4 catalysts could rupture the AI narrative before December 2027. First, the cash burn crisis at the Foundation Labs. OpenAI now projects $665 billion in cumulative cash burn through 2030, $25 billion in 2026, $57 billion in 2027. If capital markets refuse to keep funding that burn, hardware orders to Nvidia stop overnight. Second, the Rubin air pocket. As hyperscalers pause Blackwell purchases waiting for Rubin in late 2026, Nvidia could miss revenue badly. Third, an auditor or SEC mandate forcing hyperscalers back to 3-year depreciation schedules. That would trigger massive impairment charges and instantly vindicate the phantom profit thesis. Fourth, Capex exhaustion. The first time Microsoft, Google, or Meta cuts forward Capex guidance to protect dividends and buybacks, the entire narrative breaks. So what should you do? 3 things. First, recognize what Burry's trade actually is. Not an apocalypse call. A defined risk $17 million bet that pays off enormously if AI valuations crack before December 2027 and loses entirely if they do not. The asymmetry is the trade. Second, examine your own AI exposure. If you own an S&P 500 index fund, roughly 35% of your portfolio is in the Magnificent Seven. You are long the AI Capex trade whether you know it or not. Third, write your plan now. Decide today what you will do if Nvidia falls 40%. Decide what you will do if it falls 80%. Because if Burry is right, those days are coming. The man who diagnosed subprime in 2007 just deregistered his fund, walked away from Wall Street, and bet asymmetrically against AI. The original Cassandra was right. Nobody listened until the city was burning. If you want to see what stocks the smartest investors are quietly buying while everyone else chases AI, watch this video next and subscribe. Just a reminder, I'm not a financial advisor. This video is educational only, and results depend on your own decisions.